Hello. I'm Tamara Wren, the tax doula, and today I'm here with a tax tip on tax brackets and exactly how do tax brackets work. As your income increases, you are taxed at a higher tax bracket. However, your entire income is not taxed at that bracket, only the percentage that falls within that layer. Today, I'm going to share with you what that actually looks like, and I'm going to focus on the single taxpayer and their tax brackets. So, for example, there are several tax brackets that you can have your income calculated in. The first one is the 10% tax bracket, which is for taxable income that's between 0 and $11,600. The next tax bracket is 12%, which goes from $11,601 of taxable income to $47,150. The third tax bracket is 22%, which is $47,151 of your taxable income, up to $100,525. The fourth tax bracket for a single taxpayer is 24%. That's $100,526 of taxable income, up to $191,950. The next one is 32% at $191,951 to $243,725. There are two more tax brackets, 35% at $243,726 of taxable income, up to $609,350. And the last tax bracket is $609,351 of taxable income and up. So as you can see here, there are 7 tax brackets for the single taxpayer. Now, the more income you make doesn't mean that all of your income is taxed at that bracket. It simply means a percentage of your income is charged at that bracket. So here is an example from the IRS. Let's say you are a single person with a taxable income of $58,000 per year. This is after all the adjustments and everything is done. That's the amount that you're going to be, you have to pay taxes on, $58,000. So the first portion of that income is taxed at 10%. And that is the amount of income that is between 0 and $11,600. So that portion of your income is taxed at 10%. From there, you go up in the portion of your income that's $11,601 to $47,150 is taxed at 12%. So now you're adding that first portion taxed at 10%, the second portion taxed at 12%, and then you add those together for your taxable income. And then the last portion is between $47,151 up to that $58,000, and that portion is taxed at 22%. So here you've taken the first portion taxed at 10%, then you add the second portion taxed at 12%, and you add the third portion taxed at 22%. And that is how your taxes are calculated for the year. And this is why it's extremely important if you have multiple jobs. You have to be really careful about how your jobs, how you fill out your W-4 form and how you are taxed, because one job, you might be making $58,000, like this example. You might be making $58,000 at that job. And so they may tax you correctly, but then if you have a second job and you're making $20,000 on that job, now they're taxing you based on the income that you're receiving from that job, when in actuality, now you have a combined income that is $78,000 and should be taxed differently. So it's important for you, if you have multiple jobs, to make sure you're running those numbers and you're adding the taxable income together in a way that doesn't end up at the end of the year you're owing thousands of dollars because you were looking at each income source as individual. Now, they may be taxing you correctly at each individual job, but when you combine those salaries together, it puts you in a higher tax bracket. So it's really important for you to just check during the middle of the year. If you've got multiple jobs, maybe quarterly, you want to just check and see what those numbers look like and run them. And you can always adjust the W-4s forms at your jobs, as well as you can always go online and pay that additional tax that you should have been paying during the year. So that is my tax tip for today, educating you on the federal income tax rates and the tax brackets. Until next time, I'm Tamara Wren, the tax doula. Bye.